everyone. Today I'm going to be going over a virtually riskless option strategy that as long as you own 100 shares of stock and you're willing to sell your 100 shares, it's virtually risk-free. So stick around and I'll show you why. All right, guys, so let's go over what a covered call actually is. So a covered call, when you sell a covered call, you're simply selling a contract saying that you will sell 100 shares for the strike price that you sold your contract at. So that is the strike price, wherever you're willing to sell your 100 shares, whatever price you're willing to sell your 100 shares for. In this example, for this graph here, the strike price is $40. That's what you're willing to sell your 100 shares for. Currently, the stock price is trading at $39. So you have $3,900 in this stock A price, okay? And you're willing to sell it for $40. So you're willing to, if the stock price moves up and you make $100, now you're at $4,000, you're willing to sell your shares at that $40. Now let's say that you sell this contract for $200 or for $100, excuse me. That means that you now have a potential profit of at least of $200. If the share price goes down, let's say to $38, that is your break-even point because you sold a contract for $100, which you get to keep regardless of anything. The share price fell $100 and you currently break even. If the share price falls anywhere below this $38, you technically lose money, but if you're willing to hold the shares for the foreseeable future, which is this your second requirement here, if you're willing to hold your shares for the foreseeable future and not sell out of them, then it's an unrealized loss and there's no risk there. You just hold it and wait for the stock price to come back up. You can keep selling covered calls as long as it's above your what you bought the shares for. So as long as you own 100 shares, you're willing to hold these shares for the foreseeable future, and you're willing to sell your shares at the strike price that you are selling for. Granted, this has to be over what you paid for the shares to begin with. So your cost basis, what you actually paid for each share. Let's say I paid in this example $35 for the shares. So even if I sold at $38, I'd still be making money on this no matter what. If I sold at $38 and I had a cost basis of $35, so $3,500, and I sold at $38, I'd still be making $300 plus the $100 that I sold in premium. But this will never happen because if the share price is not over the strike price, then no one is going to execute their option. So a covered call is a virtually riskless strategy as long as you're willing to hold the underlying stock for the foreseeable future. I will now show you guys how I actually sell these covered calls, and make sure that you're on a broker that has very low fees or has no fees, because fees can really eat into your premiums here. And as long as you're using a broker that has no fees for selling options and buying options, then you should be fine. Just keep that in mind. It's not very profitable if you have a $5 fee for selling and buying options. Okay, so now I'll go into Robinhood and show you guys how I actually sell covered calls. All right, so let's go over how I actually conduct these trades. Hopefully it makes a little more sense for you guys when you see some actual numbers in here rather than just a graph. I've always hated those option graphs. Okay, so this is XLF, which is the finance sector for the S&P 500. So this has companies like Berkshire Hathaway, Bank of America, JP Morgan, just to name a few. The cool thing about this sector is that it behaves a lot like bonds in that it's heavily influenced by interest rates, because banks primarily make their money from giving out loans, and interest rates directly affect how much profit they can make. So as long as you understand that banks are going to be around forever, they're not going to go anywhere anytime soon, and people are always going to need loans, things like that, then banks behave, you realize that banks behave a lot like corporate bonds, and just a little bit riskier, okay? So with these bonds, right, quote unquote bonds, or the XLF sector, okay, um, you can sell covered calls and make 20% or so APY a year, regardless really of what the stock does. If the stock remains flat, you can make 20% a year easy. Okay, so my current value of these 100 shares is about $27.50 right now. My cost to buy these shares was only $24.75. So keep those two numbers in your head, okay? So 27.6 is the current share price, okay? 27.6, right? And 24.75 was how much it cost me. Now let's go into the options chain here and look at some of the options, okay? So we want to sell a call because we own 100 shares and we're selling covered calls here. So if you look at this little -1 here, this is actually the call that I sold for this week. And it is at $28 because if the share price goes up to $28, okay, here's what will happen. If the share price goes up to $28, then I will be forced to sell my 100 shares for $28 each, meaning that I will lock in a gain of about $300 because my cost for these shares was at $24.75, way down here, okay? But I'm selling a covered call way up here for $28, and as long as I just sell right here, I will earn $300 plus the premium that I got from selling this call, okay? Now, let's say the share price is way down here, okay? It's at $24. I have to sell my covered call at or above $25 because my cost basis was $24.75, okay? So as long as I sell above $25, because they don't have decimals here, they only have 0.5. So as long as I sell above $25, then I will, regardless of what the share price does, I will certainly not lose money. I will not be forced to sell. I can hold on to the stock and wait till next week. Hopefully it goes up next week, okay? So I hope that makes sense for y'all. Just don't sell below your cost basis. Whatever you bought the shares at, just don't sell below that. Don't sell a call for the strike price below that. As long as you do that, you will be guaranteed to not lose money. Okay, just don't sell your shares. And that is pretty much all I have for selling covered calls here. The next video that I plan on updating is the wheel strategy, why I use XLF, some things like that, and how I've been doing in my wheel strategy, how I've been progressing, and how you can earn actually 20% per year. I know $8 doesn't seem like a lot, but if you do it's $8 a week, right, guys? Okay, for your $2,700, and if you annualize that $8 a week, you're making about $500 a year, and that's about a 20% return on $2,600. I'll get into all of this, your profit and loss, your break evens, and your expected return, all in the next video. I just wanted to share with you guys covered calls and how you can execute them with virtually no risk. All right, well, take care, guys, and I will see you guys in the next one.